Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Stocks began diving pretty hard today as investors were digesting the hawkish stance by the Fed and all that was disclosed yesterday. The S&P 500 was up 0.4%, the Dow Jones was up 0.3% and Nasdaq recovered and closed even. Remember that higher interest rates can make growth stocks relatively less attractive, hence why tech stocks were sliding down earlier in the day. Bond yields gained, with the 10-year Treasury rising to 2.56%. Loopring released their quarterly update. Some of the major milestones were that they passed $4.6 billion in trading volume on Loopring Layer 2. Over 3 million NFTs were minted on Loopring Layer 2 following their launch, and over 65,000 accounts with 30,000 Loopring smart wallets were activated. Looking forward to the road ahead, Loopring plans to allow users to earn yield on their Ethereum and stable coins. They announced Collab Land will be supporting Loopring Layer 2. They also stated they will keep on supporting the Loopringverse with more NFTs and an improved headquarters. Nothing new came from GameStop nor AMC today, and the day overall was pretty much uneventful aside from that huge market dip. However, those in my Discord will say otherwise, for some of the day trades today yielded upwards of 10% in gains. With over 10 alerts having gone out, and all profitable, my Discord members were able to make between 10 and over 57% in gains on their entries. A massive success which is open for anyone to see for themselves if you come join us. The link will be down in the comments and video description. Let's talk about performance. The Fed submitted over $1.734 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 54% of the total volume today, while dark pool trades for GameStop accounted % of the total volume today. AMC had a larger amount of buy orders than sell orders, with GameStop also having a larger amount of buy orders than sell orders. AMC had a bearish day, losing over 3%. It began with a bearish performance during the pre-market, and it would amplify and extend once markets opened, dropping AMC from 20.60 all the way down below 18.70. AMC began slightly recovering for the rest of the day, closing at 19.73 on a dip, above the VWAP. As for tomorrow, support will be found at 19.30, 18.70 and 80. Resistance will be met at 19.20, 20.40 and 21. GameStop had a bearish day, losing over 4%. After a weak pre-market trading session, GameStop amplified its descent, dipping under 142 at one point before it began recovering. It closed at 150, above the VWAP. Support will be found at 150, 147 and 142. Resistance will be met at 152, 156 and 160. On this next part of the video, I am simply going to copy and paste this morning's video segment for those interested in listening to it. If you want to skip that segment, I want to thank you for tuning in today for this short afternoon recap. Be sure to join the Discord for a lot more content too. I wish you an amazing rest of your day and to the moon. Hey guys, all content discussed in this channel is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. Today we are going to talk about power and influence. Over the last couple of decades, the undoing of the oversights, restrictions and regulations imposed on Wall Street have led them to increase their influence on corporations as well as the government. Even after 2008, Wall Street was able to buy their weight into politicians to weaken the new regulations that came about to not let a new economic recession to occur. Today we are going to talk about the power of Wall Street, and what the price has been for it. It will be a very grim but eye-opening video, and one which will validate a lot of your biases and theories about how the world really works. I want to thank Gautam Mukunda for his great journalistic work which inspired me to make this video. When Boeing released their 787, they had a ton of problems. They were overrun by battery fires and massive costs. Products often have issues when they are released, but the difference here is that the problems that came about this botched product release stemmed from the type of decisions that Wall Street forces companies to make. Boeing once prided itself by having an engineering-driven culture, but that all changed when they merged with McDonnell Douglas. Boeing used to be a daring company that was very risk-prone in looking to make the next daring investment, but McDonnell Douglas was the polar opposite. They were risk-averse and liked to focus on cutting costs and obsessing over metric figures. The 787 project released faulty because, even when career-long Boeing engineers protested, the company decided to outsource a lot of the development and assets. As the engineers predicted, the product was an absolute botched release that stained the name of the company and tarnished its once prestigious legacy. Boeing's decision to be risk-averse came directly from Wall Street. The obsession to have the return on net assets, otherwise known as RONA, is a key metric that influences many firms, mostly because it can be used to maximize short-term share prices. According to research, most publicly held companies invest only half as much into their own assets in contrast to privately held companies. Sara Lee's CEO, in an eye-opening interview that did not get nearly enough attention, stated, and I quote, "Wall Street can wipe you out. They are the rule setters and they have decided to give premiums to companies that harbor the most profits for the least assets." In their duty to seek higher stock returns, companies like Sara Lee and Boeing were forced to outsource manufacturing, even when there is objective data that shows that integrating research and development along with manufacturing lead to better innovation. Wall Street's influence has been forcing companies to hinder innovation, mostly because Wall Street is very short-sighted. And now comes one of the main pillars of misunderstanding that we need to correct. There is this certain notion, used mostly as a deference to Wall Street, that companies have a fiduciary duty to maximize shareholder returns. This belief has been compounded by the media over and over, but there is one simple problem: this is not true at all. A fiduciary duty is just a specific legal obligation, and under no existing law, or that ever existed in the past for that matter, is any executive forced to follow this requirement. In simpler terms, there is no source that makes true the statement that companies and executives have a fiduciary duty to maximize shareholder returns. There is no legal framework to enforce it at all. So the question evolves to, why are executives making decisions that are bad for the company long-term actively knowing that they will yield lesser results? The answer is simple: when a group or single sector manages to monopolize power and dominates the minds of what society thinks, you get these types of contorted and irrational decisions. Wall Street is that group, that sector, which forces companies to act against their better interests. After the Great Depression, the United States passed the Glass-Steagall Act and other legislation to increase regulation on Wall Street and therefore make the economy more stable. But Wall Street will never go out without a fight, and while our attention of the next decades became focused on the Cold War and the war on drugs, Wall Street worked tirelessly to undo these regulations. Looking at the financial sector's growth, in 1970, the profits of the finance and insurance companies represented 24% of all other sectors combined. By 2013, that percentage number grew past 37%. In 1950, the finance and insurance industries made up 4.2% of the GDP of the United States, but by 2012, the number had grown past 7%. This change is actually underestimated. Non-financial companies have begun raking in huge profits from their financial departments. Did you know Ford makes more money selling loans than by selling cars? This increase in size, which continues to grow year over year on average, has also corrupted its way into the government. From 1998 to 2013, the finance, insurance and real estate industries spent a combined $6 billion on lobbying. During the 2008 crash, the financial sector actually intensified their pressure on the government. The research of Gautam Mukunda showed that a politician's path to power will crucially shape their actions in office. People who spend a lot of their time and career involved in the financial sector are likely to share its worldview. This is crucial to think about, because we often think about corruption as just taking a bribe and looking the other way when doing an immoral deed, but it's a lot more complicated than that. It isn't necessarily a single action, but the act of simply hanging around a lot with financial institutions and the people that work for them that will morph and change how you think. Remember, you are only the average of the people you hang around. I don't think I need to tell you guys how powerful Wall Street is, but here are notable examples Mukunda provided that really put this statement in perspective. Attorney General Eric Holder testified before Congress that he should not prosecute Wall Street because it could endanger the economy. The government's chief law enforcement office literally declared Wall Street above the law. The Commodity Futures Trading Commission attempted to regulate derivatives, but Wall Street began a huge campaign of efforts to counter this, ending in the CFTC being only able to regulate less than 20% of the world market. Wall Street worked hard to slow down rules that prevented banks from using federally insured deposits to trade on their own behalf. Wall Street's success in being able to penetrate and monopolize all aspects of the government, and the world for that matter, come from their ability to successfully increase their domain in financialization. Financialization, to put it short and brief, is when the influence of the financial markets, institutions and elites over the economy and institutions of a society. The common theme used for this is the elites and the rich running the world. This is very dangerous for obvious reasons, but I am going to give you very objective examples which you can use to better understand why this is about the worst thing that can happen. Scientific data consistently shows that when the financial system of any given country grows too large, it inhibits growth and increases volatility. This, in mathematical models, is reflected as when the private sector credit reaches 80 to 100% of the GDP of any particular country. In the United States, as of this year in 2022, the private sector credit is over 216% of the GDP. Financialization, otherwise known as when the rich, the elite in the financial markets, undermines the economy in two ways. One is that the larger and more complex these systems are, the more likely they are to crash. We have seen just how unstable the economy is becoming and how volatile everything is. This is all a result of feminization. The second way financialization undermined the economy is because it misallocates resources. We talked about this earlier. It all becomes hyper-focused on metrics for short-term gains, which eventually forces company executives to spend less time in research and development and more time on outsourcing the development of everything and finding ways to maximize shareholder returns. So now that we have a strong, objective and firm understanding of the problem of Wall Street, their rise to power, their danger to society and the current state of affairs we find ourselves in as a result of all of this, how do we fix it? It's hard to say exactly how to even approach this problem, but Gautam Mukunda did make a pretty remarkable suggestion. The path to recovery should begin by limiting the size and leverage of the banks. Banks grew excessively after they began deregulating themselves in the 1950s and have continued doing so after. The way they excuse this is by increasing their leverage on the economy, which allows them to use it as an excuse of why they act the way they do when questioned by Congress. The risk has shifted to the public every single time there is a bailout, and that has to stop by limiting the bank's liabilities. Another way to go about it is by removing subsidies for debt. Debt markets are bigger than equity markets, and this is dangerous because debt creates much more risk than equity. If you rewrite the tax code, you can remove the subsidy and therefore decrease the power of the financial sector over the rest of the economy. These two solutions could have very profound effects on beginning to tilt things back to balance, and they would be great starter points. Things are worsening by the day, and there is this weird feeling as if we are living on a paper castle, as if something with enough force could collapse everything. More and more we become entrenched, people become more financially constrained with lesser alternatives or ways of getting out. We have reached a boiling point where a catastrophic event doesn't need to be the biggest ever in order to have us all fall. Let's talk about the problems we face with an open mind and aim to better inform ourselves to make better decisions. I hope this video was helpful and informative. I think it's one of the best in the channel. Let me know what you think in the comments below, and that is all I have for you guys. Thank you for making it to the end of the video if you are still here. Be sure to come on over and join the Discord for an even more engaging experience with fellow investors. We have tons of things there, from conversations about GameStop and AMC to day trading alerts, so give it a try. Links will be down in the video description. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.